In past 2 days, we have seen conflict in West Asia spiraling out of control. This comes after Israel launched a preemptive strike on Iran's nuclear site. Since then, we have seen multiple exchanges between the two sides. As Iran threatens closing Strait of Hormuz and UK moves troop in area, situation is likely to escalate. Coming Monday, we can expect market meltdown across the world, and a lot of companies will be impacted by this. Talking about Indian companies, the list includes JK Tyres, Akzo Nobel, Kansai Nerolac, Hindustan Petroleum, Apllo Tyres, IOCL, Bharat Petroleum, Indigo Paints, Asian Paints, Balakrishna Industries, Sirka Paints, SIAT, MRF, Berger Paints, and a lot more. So, in today's episode, we are going to discuss how these companies are going to be impacted by growing conflict and this conflict in West Asia. So, without wasting much time, let's start this episode. So first up, we have JK Tires. JK Tires is a tire manufacturing company. This company is engaged in manufacturing of tire tubes and flaps. Its geographical segments include India, Mexico, and others. So this company has good amount of exports in its product profile. Its tire products consist of truck, bus, radial, and bias, passenger car radials, two, three-wheeler tires, light commercial vehicles and small commercial vehicles bias and radial, off-highway tires, as well as specialty tires for racing. So clearly, this company is mainly involved in almost all aspects of tire manufacturing, and to some extent, they are also exporting their products. So as this like conflict increases, this company will be impacted negatively because tire manufacturing requires raw materials, which is byproduct of crude oil. So if the byproduct of crude oil, the prices of them will increase, then this company will face higher commodity prices for its raw material, and hence the margins will feel the pressure for this company. Now let's take a look at fundamental and technical analysis of JK Tires. So as per the fundamental analysis, revenue is down from 15,000 crore to 14,500 crore. Now this can be because of either increase in the prices because of commodity prices increasing, but in past few years, like past 1 year, 1.5 year, I don't think the prices of oil has been really high for at least Indian companies or Indian consumers because we are able to import oil from Russia. So maybe this entire drop in sales or revenue is because of some other reason. Maybe it can be competition increasing or some other reason, but you have to like deep dive into it. The operating income of the company also declined from 1628 crore to 1110 crore. Net profit also declined compared to last year. If we see the cash flow statement, cash flow from operating activities was also down. So clearly there is something going on in the recent times in this company, how the company is being operated, and you can also see the effects of these news and these not news, these signals on the stock price. Since the profits are down, since the cash flow is down, you will be observing companies stock feeling the pressure right now. Apart from that, total assets in this company stands at 14,500 crore, and total debt is at around 5,000 crore. So along with that, the company has been paying dividend of almost 3 rupees in FY25, which is lower than the company's dividend in FY24, 4.50 rupees, which is signaling that shareholders are getting less cash on like the invested amount. But again, when you are investing in a company, you are not looking for dividends and you're not looking for cash. Like a lot of investors invest this with this philosophy that hey, if I invest in a dividend giving company, then I'll be generating a like good amount of return per month. But you have to understand that that amount of money is taxable. So if you are in a bracket which is who is earning like less than 5 lakh 6 lakh, this is a really bad idea for you to investing in dividend paying companies. Like if you have a huge capital that you want to protect and generate some returns out of it, then it makes sense to invest in a dividend based company. But when you are dealing with small chunk sums of money, it's not highly logical to deal with dividend based company because you are eventually paying taxes to the government whenever the companies are paying you dividends. If we see the technical analysis of the company, then in last 5 days, the company looks like it's having a short-term bullish momentum. I don't know the reason for that, but over a period of 100 days, 300 days. There is a resistance at 380, and there is a support for this company at 330 and 325. So the company is, or the stock is in right now a uptrend, a short term uptrend. I don't know the reason for it. Logically, it should be going down because oil prices are increasing. So concluding, the stock is clearly in a short-term upward trend, but if you take a medium-term horizon or 20-day moving average, then the stock looks flattening, and it's probably in its consolidation phase right now. And from here, the company is going to face a decent amount of headwind along with the fall in sales and profit. So it's going to be really challenging for this company to like trade at a higher valuation than this, given the future right now. Also, if we take a look at the volume analysis, there have been decent volume being traded in last 1 or 2 months in this particular company, and specifically in last 20 days. So recent volume spikes tells you that there has been some amount of institutional buying when the stock was in the correction phase. Now, if we see the volume data on Grow, we can clearly see in last 20 days there was a big transaction that happened. That means some institutional investor did come into this stock, and that's the reason for a short-term bull trend into this particular company. Now it can be a manipulation or a short-term trade as well, because you never know when these institutional investors are either buying or selling, but it's a risk you have to bear. Next we have is Akzo Nobel India. This is a coatings company engaged in manufacturing, providing paint, synthetic enamels, colorants, and thinners. The company business unit includes decorative paints, automotives, and specialty coatings, powder coatings, industrial coatings, marine and protective coatings. Decorative paint business offers a range of products, including paints, lacquers, and varnishes. It also supplies a range of mixing machines, color concepts, and training initiatives to the building and renovation industry. So this company is a competitor of Asian Paints, Berger Paints, and all the paint business that exist in our country. Now let's see how this company's fundamental and technical analysis looks like right now. If we take a look at fundamental analysis for Akzo Paints, the stock is right now trading at 3,238 rupees. The company is a leading coating company with strong brand like Dulux, Sikkens, Interpon. Okay, I've heard of Dulux. Diversified across decorative paints, automotive, industrial, and marine coatings. Makes sense. The revenue year over year increased by 3%, profit increased by 0.7%. So the stock has been, to some extent, must have been performing in a flat way, in my opinion, because there is no increase in profits and revenue in last 1 year. So I do not expect the stock to even go from last September levels. Apart from that, the company to some extent is debt free with only 62 crore of debt. That's a good sign for a company. The company has a healthy equity base. The book value for company is 291. I think that is to some extent irrelevant. The company has a healthy cash reserve, but it has been declining because they are paying out dividends and working capital changes. Okay, so if they are paying out dividends, that's something to note about, because if a company is paying out dividends, that means they are not able to use the cash they have with them to fuel their growth, next level of growth. So, if we want to summarize this, the company appears to be at trading at a premium valuation, but the company has a brand, and that gives it its premium valuation. So the company has major risk as high valuation than this. New changes happening in the Middle East and oil prices increasing, and all the paint business like along with this will be impacted. It's not going to be a different story for Asian Paints or Berger Paints. If you see the expansion potential, like whenever the push comes to shove and the company has to put in some capital to expand, they'll be sitting on a healthy cash flow and cash to fuel that expansion, because they're paying out dividends already. That means they have free cash available and they don't have any debt. So over a medium term, I think this is a hold. It does not make sense to invest more money in this company right now, because the stock was trading at a already premium valuation, and I don't see prices moving from here. However, if the stock corrects deeply, like 20%, 30% from this level, then bulk buying opportunity opens up. But the company has strong fundamentals and it has a strong brand presence. And brand presence is something that you cannot just take away from users' head. So this company will always have this moat around it. But again, the competition from other players is also notable because Asian Paints, Berger Paints are not a small player in Indian market. So if you are a long-term investor and like this company might be a good opportunity if the price goes down in 1 to 2 months. So keep a track on this particular company because buying opportunities are going to open in this particular stock in coming days. Next, we have Nerolac Paint. Now, this is a paint manufacturing company and they are diversified across multiple segments. They are offering range of products including automotive coating, powder coating, performance coating, and coating liquid to auto refinish. Now, let's take a look at the fundamental and technical analysis of this company. Now, if we take a look at fundamental analysis of the company's revenue was reported at 7,800 crore, which is a stable performance and it did not increase with respect to last year. And the profitability of the company also was lower with respect to last year. It decreased by almost 42 crore, 43 crore, but it's not a huge amount. So if we compare Nerolac with Akzo Nobel or Deluxe, you'll see in both of these companies, the sales did not increase by much, even though in like Akzo Nobel, the sales dropped and profit also dropped. So clearly, when the market heat was on, this company was able to perform relatively better and they were able to sell their products relative to that company. I don't know what's the reason for that because that's a huge drop in their sales and revenue number over 1 year. However, the cash flow improved to 672 crores in FY 2025 from 903 crores in FY 2024, while the capital expenditure increased to 326 crore from 237 crore. That means they are either thinking about uh, they are thinking about capex and increasing the production capacity. So you can expect in the next wave or next cycle of growth, this company might perform really good. I don't know what's the capex amount right now, but we might have to dig in to understand the plans. The balance sheet of the company remains strong with total assets of around 8,000 crore and total equity of around 6,400 crore. However, total debt increased to 296 crore from 276 crore, which is not a major amount. I still think the debt to equity is relatively low, less than zero point 0.1. The company has been paying some dividends. The company is not aggressive in paying its dividends because they are also thinking about capital expenditure. And the promoters have a 75% stake in the company and they are not diluting. That means they have a high stake in the game and they will want the company to succeed. So it has some good mixes of what a good company can be: high promoter holdings, low debt. The company did not change, that the company sales did not change over last 1 year when the entire segment was observing downturn. So it might be a good position or it might have a moat around it, which I might not be able to understand right now. I think this company is one of the top three paint business in India, from including like Asian Paint, Bergner Paints, and Nerolac Paints. And the company maintains a strong fundamentals, and that's why the valuation of this company, even though it has been correcting over last 1 year, is still trading at a premium valuation. Even though the stock price of this particular stock has been correcting over last 1 year and it has been depressed, I don't see any major negative news coming out in terms of lack of like management capabilities or management fraud. So that's a good thing in this company. So if we take a look at the technical analysis summary of Nerolac Paints, in short-term trend, the stock has seen a downward correction in past few weeks. If we take a look at the term trend, there has been a resistance at 254 to 255 level, and the stock is unable to sustain this zone, and it like dropped down that zone, and it's now in a bear level. The next support level that comes after this is 225 and 230 level. The momentum indicators indicate that it's neutral to oversold territory. That means it might start making sense to start building position in this if you are a long-term investor. So from a medium to short-term point of view, the stock can face some downward pressure, but from a longer-term point of view, the company has strong fundamental and it can generate a good ROC. and it has a dominant position in Indian market. Next, we have Hindustan Petroleum. Now, HPCL is engaged in business of refining crude oil and marketing of petroleum products, production of hydrocarbons, and providing services for management and exploration and production of block generation power and operating liquefied natural gas. Now, this company has both business vertical, refining and exploration vertical. Whenever you see crude prices increasing, these prices can be passed down to the consumer, or government is going to take the brunt of it. But the end goal is, as the as the oil prices go up, uh, the refining business will generate more profit, the exploration business will generate more profit, because the government will be incentivizing these guys to go out and find more petrol field or natural gas field, because they don't want to rely on imports, because the oil prices are up and they have to use dollars to buy it. So these companies are naturally will benefit from this. I usually stay away from all the PSU companies, because PSU companies have a main motive of serving the nation, not generating profits for the shareholders. Anytime a CEO of a PSU company will be taking a decision, he'll be taking a decision based on these two factors: betterment of the nation or generate more profits. And sometimes both of them might not align. Sometimes you might have to invest in things that are loss making because they are of strategic importance to you. So that's why I feel like I usually stay away from PSU companies. Uh, but there's always opportunity that I'm missing. I never got chance to join the rally of PSU that happened 2 years ago. But that's something that I have to live with, and I cannot do anything about it. But that's the story about HPCL. Let's take a look at fundamental and technical analysis. If we take a look at the fundamental analysis of the company now, this is a mid cap company with almost $10 billion valuation, and it's operating in oil and gas sector. The company has almost 55% holding, with huge amount of institutional holding, almost 27%. The company's profitability has been improving. It increased by almost 26% in 1 year, and the company has been improving its margins, like refining margins, GRMs. Also, it's focusing towards some long-term tie-ups, LNG supply agreement with ADNOC Trading, collaboration with IGX to boost gas consumption in India. Now, IGX is okay. So about a tie-up with IGX, I was not aware about this. So IGX stands for Indian Gas Exchange, which is a national level automated spot gas trading platform. That means they are thinking about exporting the gas to other parts of India, other states, so that trading can happen. And it was launched with the aim of creating transparent and efficient market for natural gas in India. The exchange is promoted by Gujarat Gas Corporation Limited, a joint venture between GAIL, Gas Authority of India Limited, and Gujarat State Petronet Limited. Now, this is a interesting thing to note here, that they are thinking about these kind of tie-ups and long-term tie-ups, because when they have natural gas getting produced, they want to expand the consumption, and expanding it through means of a trading channel or a trading platform is the easiest way to do so, because suddenly your gas is in the free market, and it will be bought and sold according to the best buyers and sellers who can give the right price for the right demand. So this is a good tie-up that like HPCL is thinking about from a long-term point of view. The company's P is trading at 40 now. All the PSU, all the commodity-based company usually trade relatively lower, and so but the good thing is, from this point of view, the company, since it's like trading at a really cheap valuation or low valuation, the upside potential is relatively high. Now, if this war breaks out and it escalates, this company is bound to benefit. All oil and natural gas exploration companies are bound to benefit. Next, we have Apollo Tyres, who is a direct competitor of JK Tyres. Now, Apollo Tyres operates through automobile tires, automobile tubes, automobile flaps segment. Its geographical segments include APMEA, Europe, and others. APMEA segment includes manufacturing and sales operation through India and includes entities in UAE, Thailand, Malaysia, and South Africa. The Europe segment includes manufacturing and sales operation through the entities in Europe. The other segments include sales operation in the Americas and other corporate entities. The company markets its product under two global brands such as Apollo and Vredestian. The Apollo brand is available across various categories, including commercial passenger vehicles, two vehicles, farm, and industrial. The Vredestian brand products include car tires, tires for agriculture and industrial application, and bicycle tires. So this company has diversified product portfolio. Also, it has diversified presence across multiple geography, both in terms of manufacturing and in terms of consumption, which is a good thing because the more diversified portfolio you have, the more shocks you can absorb. Even though the commodity prices are going to rise across the world because oil is a is it's like a free market or economy, right? Like whoever pays the most amount of price for oil gets that oil. So the commodity prices for this, which is oil, is going to increase. But let's see how the fundamental and technical analysis of this company looks like for understanding more about this. So, if we take a look at the fundamental analysis of Apollo Tires, the revenue has gone up by 2.94%, and right now it's sitting at almost 26,100 crore. The net profit of the company is stands at 1,121 crore with margin standing at 4.29%. The company has a strong operating cash flow, almost 1,800 crore, and free cash flow of almost 1,100 crore. Now, if we see the valuation, the company is trading at fair valuation, I would say. It's not a premium valuation. It's trading at around 25 p, and with respect to book value, it's twice its current book value. The company has a return on equity of almost 7% and ROC of almost 10.6%. If we take a look at the growth of the company has shown a slow growth over last 1 year, almost 2.94%, which is down from 5.6% a year before. Also, the company's profit declined in this year with respect to last year, which is sign to be worry about, and it's a drop of all. This drop in profit comes under spotlight of multiple factors, but one of the factors was the net margins of the operations dropped last year from 24 to 25, and even though the EBITDA margins remained stable, but net margins saw a compression. Now you have to go into the details why the net margins decreased. Maybe it was because of volatility of oil over last 1 year, or it was because of increasing manufacturing or labor cost. But these are the reason what can lead to uh, drop in net margins over last 1 year. So let's take a look at some technical indicators from 1 to 3 month point of view. Since the current price right now is 451, and there are bearish trends in the market for this particular stock, the company or the stock has been in a consolidation phase for last 1.5 year. If we talk about 1 year outlook, the company is going to trade to some extent sideways. The company has a resistance of 480 to 500, and it has been trading in this particular range for a decent amount of time with a high of 584. The company has a lower level support of 435 to 440 right now, with a strong support at 390, which is a 52 week low. So from medium term point of view, the trends are neutral to bullish, not neutral to bearish, neutral to bullish. From a long term point of view, the company has a strong fundamental and the trend looks bullish because the company operates in tire manufacturing space, and the country will have a high demand for tires in the coming year as we become a more developed economy, as more people buy vehicle cars and like two wheelers. So from a long term point of view, I think this is a good buy. And as there is some amount of selling coming in because of these trends that are happening in the global oil market, if you're a long term investor, this company should be on your short list. Next, we have Indian Oil Corporation Limited. Now, IOCL has activities across gas and oil exploration, explosive and cryogenic business, and windmill and solar power generation. And its business span across marketing to exploration and to production of crude oil and gas. So the company is end-to-end product producer and supplier of oil in country, and you must have seen IOCL petrol pump at many places in India as well. So let's get into the fundamental and the technical analysis of the company. First, let's take a look at fundamental analysis of this company. So IOCL has seen a good revenue and profit growth in last 1 year. The revenue jumped by 14.7% and profit jumped by almost 26.7%. The profit right now stands at 38,000 crore, which is a significant amount. The ROC and ROE also saw an expansion. Apart from that, the company has a strong balance sheet with low leverage, healthy cash reserves, which they can use to fuel their future growth. The company is paying dividend, and the company paid almost 17.5 rupees per share dividend last year, which is almost equivalent to 4%. That is more than the savings rate of most of the banks in this country right now. So rather than keeping your money in savings bank account, this might be a place that can give you more returns. But it's not promised that they're going to give the same amount of dividends next year. That's also a thing, right? So what are the growth initiatives that they're taking? So the capacity expansion is underway for this company. They are planning to open more refineries, and they're planning to increase their capacity by 25% by 2050, which is not a significant amount if you think about it. So the main growth is going to come from the green energy push. They have tie-ups with NTPC, Tata Power, Panasonic for renewable energy, EV charging, and lithium-ion batteries. Apart from that, they are also investing in green hydrogen. They're developing a green hydrogen plant in Panipat along with India's net zero goals. The company also has government backing. Since it's a PSU, it has always access to cheap capital from the government because they are not going to prioritize profits over public good. That's their main. Some of the lowlights for this company are, first of all, it's facing high refining margin because of volatility in crude oil prices. Second, the company is trading at a lower multiple relative to its competitors in the market, like HPCL, Reliance. And the company also has a business that's capital intensive in nature. The major business, which is their refining business and exploration business, you have to invest a lot of money to open a refinery to find a new oil field. So their main cash cow is a high capex business, so they don't want to expand in that, and they're thinking about expanding in green energy. Also, the company faces private player competitions. The companies like Reliance, Naira, they are also entering the market because India is a 1.4 billion people economy and they need petrol. Apart from that, the company has limited international presence. They're mostly India-based company and they operate for Indian customers only. So they are not going to be benefiting from any of the exports of petroleum products to large extent. So these are the major like lowlights that I see for this company. If we take a look at the technical analysis of the company from short-term point of view, 1 to 3 month, the company is facing a bearish trend right now with a 200-day support at 169 rupees. However, if we take a look at 1 to 3 years or 3 plus years, the company has a strong bullish potential because one, the company is trading at a really cheap valuation compared to its competitor, so it can easily correct or come back to its like entire market or entire sector. But the company has but my main reason for bullishness from a long term point of view is their energy transition. Since this company has a strong cash reserve, almost 55,000 crore right now, if they want to go heavy in energy transition, they can do that, and it will be easy for them to raise capital from the government as well because they are a PSU. That's all what I have for you for today's episode. I hope you enjoyed this video and found something useful. Do hit the like button and subscribe to Vishal Wealth View because it helps support this channel. Bye bye.